And welcome. It's Mary Ellen McGonagle here with your Friday afternoon MEM Edge show, back in the saddle after being absent last week. As usual, lots to cover today. This is the show where we bring you where the action is in the broader markets, as always, with an eye to help you prepare not only for next week, but also beyond. So let's take a look at what we are going to be covering here today. First up, as usual, we're going to take a look at the broader markets and see where did we close. Another volatile week, and we'll dig right in there. Also take a look behind the broader markets and those individual sectors and industry groups. From there, I'm going to share with you ways that you can, what I'm calling, handle these sharp rally days. We did experience certainly one of those days this week. We're seeing a lot of oversold stocks, and they are on given days experiencing these sharp rallies, short covering or otherwise. So we'll talk about that. And then also, and ways that you can capitalize on that. Also, when to buy the pullback in hot stocks. And there certainly have been areas that have zoomed to the forefront in the way of performance, certainly given the conflict continued in Russia and Ukraine. And we'll look at that. Also, taking a look at what I'm calling interesting stocks in a tough environment. So we'll go ahead and share that. But before we get into that, let's take a look at some of the more impactful news this week. And of course, unfortunately, Russia is continuing to move further into Ukraine. That, of course, is impacting a lot of the markets in the way of increased inflation, higher commodity prices, and so forth. We will get into that as we move on. Also, we did get the U.S. inflation report. The CPI report was released on Thursday, and it did show another increase in inflation up to 7.8%, a 40-year high. Gas, food, and housing prices, as we all can feel, are on the rise. So that, of course, impacted the broader markets this week. Also, today we did get news about consumer sentiment, and it did drop lower than anticipated, all about inflation fears. We're feeling that inflation out there, and of course the consumer is not going to be quite as positive on the prospects given these higher prices. Next week, big news, the Federal Reserve will be meeting. We will hear their rate announcement on Wednesday. There's an anticipation that the Fed will raise 0.25%. Certainly, given the conflict overseas, there's no desire to rile the markets further, but of course it will be very closely watched on Wednesday. And then later, or prior to that, we will get retail sales numbers for February, another market moving data point, and then housing data will also be reported next week. So let's go ahead from here and take a look at the broader markets. And I am recording this prior to the close, about 2 hours before the markets close. So it's going to be information relevant to where we are right now. And at this point in time, the S&P is holding in above this late February low. This is your next area of support on the S&P 500, and that is the 4,100 level. We can see that most of your moving averages, and they have been deteriorating, they are in downward trending phases. This is your 50-day, the red, the 21-day here with the pink. The green is that 10-day, and I'm pointing this out because as the markets have any rally attempts, as we see these moving averages trending lower, your rally attempts will conceivably occur at lower levels. Very much unlike a bullish phase when these moving averages are upward trending and we're finding support. Take a look at these outside momentum indicators. The RSI, that relative strength indicator, is negative and trending lower. Stochastics, they are a bit faster moving, and that Wednesday rally helped tip it up into an upward moving position. However, we are still in negative territory. So while we are seeing nominal bright spots as it relates to finding support above recent lows. Overall, the trend here on the S&P 500 is quite negative. So let's go ahead and take a look at some of those underlying 11 sectors in the S&P 500. And what we are looking at here is called the candle glance view. You can access this from the initial interface page here in StockCharts. So we have each of these 11 sectors. It's a 2-month daily price chart. What I like to do is go ahead and add that relative strength indicator, sort the sectors in descending order. I want to see up here in this upper quartile where those stronger areas relative to the weaker areas are. And then, of course, you want to be aware of those weaker areas. Make sure that you're not overweighted in some of these weaker areas. So let's go ahead and drill down a little bit closer here. Energy, again, another very strong week despite a drop in oil prices. So we can see on this weekly chart, we were up 3% on the week, and each of the other sectors in the S&P 500 were negative. This is the only one that was in the green. In my MEM Edge report that comes out Sunday, Wednesday, and then intraday alerts, I have, and I will again this week, drill down further as it relates to this energy sector, what to be on the lookout for to tell us that energy may be pulling back. So if you haven't already, go ahead and use that link below. There's a special offer for a 4-week trial, very well worth the $7 investment. So from here, we can see utilities, real estate, healthcare up here in the forefront. This is something else I discuss as far as why they are. Certainly they are defensive areas, no doubt. There are other dynamics that are supporting these 3 areas in particular as it relates to relative outperformance, because we can see consumer staples is another certainly defensive area of the markets, but it is not faring as well. So there is a differentiator there, but for note today is that these areas here are up at the forefront of these 3. Utilities are the only ones that have broken back above their moving averages. The other 2 areas have a little more work to do, but lots of vibrancy underneath there. And then from here, we can take a look. I talked about staples. Some of these other weaker areas, I'm sure many of you may be well aware. Technology, another tough week for this group as inflation fears, interest rate upticks and so forth are continuing to beat that industry group down. So let's drill down even a bit further. And from here, again, a 2-month daily price chart view. And what I've done is added the ETFs for areas that are relevant, certainly as far as helping investors get their arms around what may or may not be working, and then true to what is in play currently, certainly since the beginning of the year. So I do have commodities in here, as well as some areas that are growth related, volatility and so forth. Again, that RSI, relative strength indicator, I'm going to go ahead and update this again. This is being recorded prior to the close on Friday, but I'm sure the relevance is definitely going to stand. So we can see here in the forefront as it relates to commodities, these metal stocks. And as we drill further into this show, I'm going to share other commodity areas as well, but certainly silver and gold. Now, interesting, I'm going to pull up this chart of silver a longer term, because really it's not until the last, I would say, 8+ trading days that silver has, I would say, finally joined the other areas that are commodity related. And actually, I'm going to take it out even further. We're going to look at a monthly price chart, because silver of these commodity stocks is certainly the cheapest, and it's not very common for this group to really come into play. I'm looking here on the monthly. We can see coming out of that 08-09 bear market, it had a significant run up and then really has sat out for the last, let's see how many years here, 12 years or so. But more importantly here is this nice downtrend reversal that's taking place. We can take a quick look here at gold, and we will see the relative difference, if you will. Gold has been experiencing a nice rally. I'll go ahead and have that same exercise as it relates to drilling out further. And we only need to go from this down to this 2019 into the end of 20 to see a significant rally having taken place. So of the two, silver, gold, they're both very compelling, but silver could be a little more interesting relative to its valuation and historical metrics. From here, let's take a look at the 10-year yield. Very significant week. Apparently, Treasury yields have had a weekly move that has not been experienced in 10 years. And so we can see on this 10-year, we are closing the week at 2%. And that's one of those levels that is very closely watched. As we break above this 2% level, you will see movement within some underlying groups. We'll get into that. And a lot of this is a flight to safety and the idea that interest rates beginning next week are going to be on the rise. So a big move there. We'll, in this next segment, talk about some of the areas impacted by that. Brent crude, it did pull back for the week, but it is still quite elevated. It closed, or actually right now, it is trading at about $110 per barrel. We did get that early week spike up to $140. It did not last. So there is certainly a balance as far as higher oil prices helping these underlying oil stocks. But if we get up to certainly a 140 level, even 120, there is going to be negative impact as it relates to these underlying oil stocks. So we do appear poised to close at about that 110 level, but still highly elevated in these oil pricing arena. From here, let's take a look at volatility, because we did have an early week spike to a near-term high. And interestingly, we are pulling back. We are in that 29.5 level, much lower than last week's elevated close in the mid-30s. So keeping an eye on this, because we are seeing a momentum shift here in this moving average convergence divergence, implying that we could see a continuation of lowered volatility. Of course, that would be good. This is also known as the fear index, and higher volatility is not good for the market. So of note, we'll be keeping a close eye on that. I talked about higher interest rates, areas that potentially benefit. This is KRE. It is the Regional Banking ETF. Now, I will say it did have a rally this week, but not anything to get overly excited about. It was up about 0.8, almost 1% as we're recording now. And we can see the significant deterioration that banks have experienced, a lot of cross currents taking place within these banking stocks. And this rally this week, not impressive, but one of the areas that I talked about that does move as it relates to higher interest rates, oil prices, and oil stocks are another area. So let's go ahead and take this a bit further, take a look at, because you always want to be aware of those weaker areas. And software stocks down again, a big drop, almost 5% for the week, continued deterioration in that area. Medical products. So in essence, your growth areas are continuing to be sold, and your commodity and more inflation impacted areas moving up here continually to the forefront. A little bit of a mixed picture in semiconductors. This is a cyclical area, although it is high growth, down 2.2%. Not looking very constructive here, but generally it is an area that can fare well during periods of inflation, and unfortunately not so the case at this point in time. I'm going to take a brief break. When we get back, we have lots more to cover, so stay tuned. Hi, this is Mary Ellen McGonagle, author of the MEM Edge Report. In my bi-weekly report, I highlight top growth stocks as they enter buy zones, and I educate subscribers on why that stock is attractive both technically and fundamentally. In addition, you'll be alerted to when it's time to exit that stock based on negative technical action. And this biweekly report gives you confidence by providing fundamental insights into why an area of the market is strong and which companies within that strong area have the best growth profiles that'll help propel that stock higher. Subscribers to the MEM Edge report are benefiting from my expertise in uncovering top performing growth stocks. Subscribe now to take advantage of my special trial offer. And we are back. First up, I am going to talk about some of these areas that really exploded when the Ukraine and when Russia began its attack on Ukraine. And a number of defense-related stocks really moved to the upside, very strong rallies and very sound reasons. It is due to increased budget for defense, not just in the US, but globally. So these bigger defense stocks that do work not only within the US, but also overseas are going to benefit. So I'm sharing with you a daily price chart of Northrop Grumman. NOC is the ticker symbol. So this is this explosive move last week into the beginning of this week. We did experience a nice base breakout, big volume, but let's take a look because certainly this kind of a move, you can go back historically, most of the uptrends in defense names tend to be quite a bit more orderly, but certainly given the news, very explosive. So we are experiencing a pullback, certainly into the latter part of the week. So here's what we are going to want to be on the lookout for. This pullback is very natural, and we want to make sure that the RSI indicator remains up here in positive territory. Also going to be on the lookout for this moving average convergence divergence. If we see this black line crossing down through the red, it's not the end of the world as long as the MACD remains above 50, but oftentimes it can quite simply indicate a shift. We could see a consolidation phase or a potential pullback. Let's take a look at historical precedents here. September into November, a big rally. This was all about the satellite contracts that were then awarded in January. NOC, a big component of that. But the signal that told us that the pullback was more than just a pullback was that RSI turning negative. So keep your eye on that. From here, let's take a look at a couple of other names that had significant moves into certainly the beginning stages of the conflict overseas, and a number of software security stocks. Cybersecurity is a big part of the war, the front in the war there. So we can take a look at, for instance, Palo Alto, PANW, and this is one of the larger names in that software, cybersecurity. We talked about software not faring well. However, this particular area is one of the areas that had this relatively big run up, certainly compared to the software grouping. And we can see it's pulled back to its 50-day simple moving average. And this week we did get a V-shaped rally recovery attempt. Your RSI is now in positive territory, but I'm going to want to see a break above that 10-day simple moving average to tell me that there is more potential upside. That is your nearest term resistance. Let's take a look at another name that is also in that software security space. Checkpoint. This is the strongest of those software security stocks, another big run up. And we can see the stock pulled back very orderly to this upward trending 21-day simple moving average. Same phenom in the sense that it trades right up to this 10-day and pulls back. This is resistance. But if we can break above that, and we can also see that the near-term momentum naturally on this pullback has shifted, but a nice break above that 10-day would reignite this potential area. I talked about a number of commodity-related stocks that have had big moves. So let's take a look at corn, not something any of us would normally run toward, but certainly given the huge impact that this conflict has had. Wheat, corn, a lot of these grain companies are really seeing significant moves. Ukraine is a big producer and source of these products, and certainly the conflict there has really stalled any kind of exporting. So here we are with CORN, and what I wanted to point out to you here is that pullback to this 10-day moving average. Very orderly. This is more in line with what I would want to see buy on the pullback to that 10-day moving average. Let's take a look at a couple of other names that had these rallies and are essentially pulling back. This is an oil and equipment stock, smaller company. It's called Cactus, WHD, had a big move, certainly in line with other energy stocks. They did come out with numbers, pulling back very orderly to this upward trending 10-day simple moving average. And then as you can compare it to other areas, this RL had a big run, big numbers here, gapped up, and take a look at this subsequent deterioration. So again, your first sign that this is more than a pullback is that RSI dropping below that 50, big volume on the sell-off, and not an attractive chart by any means. So from here, let's see what I can share with you because we still have plenty of time. Perfect. Okay, so from here, what I did want to go ahead and share with you is the Dow, the S&P 500 down 1.7%, NASDAQ 2.2%, the Dow down relatively better, down 1%. So what we are looking at here is a candle glance view of these components. Let's take a look at why the Dow is relatively outperforming for the week. So here we are with a 2-month daily price chart of each of those 30 components in the Dow. Went ahead and added that RSI descending order. And certainly a few areas that are not going to be surprising as we have Chevron up here in the forefront. But let's take a look at some of the more from my work a little bit. Actually, Caterpillar is not really surprising as it relates to their product line for construction and mining. So we did see this big gap up, this reversal here, momentum shifting into positive territory with your MACD and relative strength. So not sure I would chase it here. It's had a significant move for the week, but let's take a look at some other areas on the move that could be somewhat interesting. Walmart, WMT, they are making strides in a lot of areas relative to food delivery. They're also moving into healthcare. However, the industry group, that consumer, actually this is part of consumer staples. We already saw that chart, not looking particularly attractive here. Let's take a look at Travelers, TRV, and we are seeing nice vibrancy in a number of these insurance companies as they have an ability to raise their rates, passing on any kind of increased costs to consumers. Another area we talked about, healthcare. This is J&J, this V-shaped higher low recovery process taking place. And then as we move on, I wanted to share with you, certainly making sure you're aware of some of these weaker areas. I showed consumer staples. Procter & Gamble is one of those major components that is deteriorating. We can see some of these other areas down here as it relates to consumers. This is Nike and KE continuing to decline. So that can be really helpful at points when we see outperformance to really get a sense of what may or may not be driving it. So from here, let's take a look. I promised to share with you some areas that are looking compelling, or certainly stocks in areas that are looking compelling. And this is part of, I did the show called The Pitch earlier this week, and I am sharing with you some of the names that I had handpicked, but were not able to, if you will, present because other presenters had already chosen those stocks. So here we are with iShares, the MSCI Global Silver Miners. And I talked about silver earlier in the show as a conceptual idea in the sense that the valuation metrics just coming into play here as well. So this is SLVP, nice break back above this 200-day simple moving average. And we can see your shorter term MAVs trending upward. So as opposed to looking at individual stocks, you may be compelled to look at an ETF. This is Floor, FLR. Now, certainly, this was a name that I was suggesting earlier in the week. We've had a significant run up subsequent to that, but this is Floor, FLR. They are construction and maintenance, but they also work with oil and gas as by way of construction and mining. So a lot of those key areas that they are representing. Let's go ahead and take a look. I'm going to share a 5-day simple moving average, and that becomes more relevant when these stocks really get moving. I'm taking us back to this October into November. Pullbacks to that 10-day do in fact turn into good buy points. Let's take a look at another area that is on the move, and this is Eagle Bulk Shipping. There are other shippers that are really in these nice confirmed uptrends, and this particular company, believe it or not, despite this run up, it's trading at 5 times their multiple relative to their prior 4-quarter earnings. It offers a 13.5% yield, a little bit smaller. It's about an 800 million market cap stock, but a lot of dynamics taking place as it relates to shipping fees, and what occurred last year is continuing to take place into this year. So this company did report their Q4 earnings on March 3rd, and very, very strong numbers. Let's take a look at an oil and gas field services stock. And this is OII, Oceaneering, and the stock did break out of a 5-year base, I'm sorry, a 5-month base at 16.4. And the company, another one, very strong earnings. There's estimated to grow earnings by 141% this year, 73% next year. A lot of price target upgrades for this particular stock. I believe I have time for one more name here, and that is BSM. It is a limited partnership stock, $2.6 billion, but it's trading at 17 times. So relative to the S&P, a little bit lower, 8.6% yielder. It is 50% earnings growth this year, 16% next year. They are a minerals and oil related LP that definitely bears taking a closer look at. And I will leave it at that. Everyone, have a great weekend. If you like what you've heard, go ahead and hit that like button. And as always, take a trial of my MEM Edge report. Again, that link is listed below. See you guys next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.